Hey, welcome back and good morning to all of our options traders once again. And every time I show a video with a chart, stock chart, it's always going to be with candlesticks. And I think it's safe to say that most of your professional traders or active traders will always use candlesticks. There's a lot of benefits. Now, they don't really convey more information than, let's say, a Western bar chart. They just make it easier. And because it's easier to identify patterns, we can get very quick glimpses into potential turning points for the markets. And so somebody had written in and asked about engulfing patterns. It's a specific type of a candlestick pattern. And like all candlestick patterns, there's a bullish and a bearish version. So let's go find out what these are all about. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So what are engulfing patterns? Well, it's one of many what are called two-candle patterns in the world of candlesticks. There's many that are just a single candle, such as a doji or a hammer. Lots of them, I would say probably the majority of them are two-candle pattern, but then there are some that are more than that. So the engulfing pattern is one of many two-candle patterns, and it just simply means that it requires two candles, two consecutive candles, to create the formation. Now, the first candle is called the setup candle, and the second candle is called the signal candle. Now, something else about candlesticks that a lot of new traders miss is that the signal quality depends on where the signal occurs. So if you get, let's say, an engulfing pattern in the middle of a sideways trend, don't pay any attention to it. It really carries no information. But if you get an engulfing pattern at the top of a very extended run or a very extended downturn, then it carries a lot of weight. So always remember that when we're talking about candlesticks, that long extended trends are far more meaningful if we get one of those patterns at these higher low points in these trends. Now, a word of caution. Remember that candlesticks are not guarantees, and that means that engulfing patterns are not guarantees. I hear a lot of traders say, oh, well, we got an engulfing pattern here or a doji, as if somehow that means that it's guaranteed to turn. It's just a little hint. It's more information, probably better than none. But you have to understand also that when a lot of people tout these candlesticks as being the crystal balls into the future, yeah, it might appear that they have high probability, but that's because you're focusing on the times that they worked. If you look at a turning point, we get maybe an upside down V on a chart, and you look right there at the crest and you say, look, there's a bearish engulfing pattern, it worked. Well, but there were probably 20 times before that where you got engulfing patterns where it didn't work. So one of the things to take from this is that you always want to wait for a confirmation. It's not really enough just to get that second candle and then say, let's act on it. You really want to see if we are actually at a turning point. But of course, even that is no guarantee, but it's certainly better than just acting on that second candle. So with those definitions out of the way, let's start with the bearish engulfing. And I like to start here because it's probably the stronger of the two between the bullish and bearish. And the reason is that, as we all know, that markets tend to fall faster and harder than they rise. Fear is a very powerful motivator. So when we see bearish engulfing patterns, those are the ones that we definitely want to watch out for. All right, so what is a bearish engulfing? Well, the way that it's created is that we have a series of a very big uptrend. Now, that doesn't mean that they're all green candles, but there are certainly going to be a lot of green candles in there. But as I just mentioned, it's going to be an extended trend. Nothing that's going sideways or just happened for 3 or 4 days. It's been going on for weeks, preferably months. And then what happens is we get our two candle pattern. So let's say that yesterday we get another green candle. So think of what's going on here. Big uptrend, lots of green candles. Yesterday we get a green candle. Looks like the trend is going to continue. And then today we get this. And this is a bearish engulfing candle. And the reason that it's significant is that there's only one way you can create it. In order to get this red body to completely engulf or overshadow yesterday's candle, we had to gap up today. So remember that for a green candle, the top is the closing trade. Opening price was down here, the bottom of the green body. The close is the top. So the close was above the open, and then look what happened today. For a red candle, it's the opposite. The top of the red is the open and the bottom is the close. So the closing price was below the open. So off the opening bell, what happened? Prices gapped up. So it appears that on the open right here, that prices were still going to continue higher. So do you see the pattern? We have this very long extended uptrend. Yesterday we got a green candle. Today we gapped up on the opening bell. But something happened during the day. Sometimes it's obvious news, other times it's not. Sometimes the crowd just starts to run. Lots of people think this is getting kind of overextended. Some selling occurs, it triggers stop orders, more people react to it. It just becomes kind of a self-fulfilling prophecy or a positive feedback loop. And then if we're seeing this candle form during the day, that can also reinforce it. And so something happened during the day to where prices fell to a level to where today's candle, this red body, again completely overshadows yesterday's. So what I mean by engulfing yesterday's candle, if we look at the top of the red body here in the bottom, if we extend a couple of imaginary lines this way, yesterday's candle sits inside of that. And ideally, we'd also like to have those shadows, those little black lines extending from the top and bottom, sitting inside as well. As I've mentioned in a previous video, this is also called an outside day because today's candle completely sits outside of yesterday's. Shows that there was a lot more volatility in today's price action. And so when we get this two candle pattern, that's our bearish engulfing. It's going to occur at a top, and we would expect that prices are now going to reverse. And so again, would I take the second candle here as the confirmation, even though it's technically called the signal candle? No, I think it's best to wait for 2 or 3 candles just to see if the markets are in fact selling off. Because remember, if you are waiting for a significant uptrend and it does turn, there's no reason you have to pick up this candle. Wait for a couple to fall, and if you get in down here, there's a very good chance you're going to see a significant sell-off, and that's where the profits are made. So once you understand a bearish engulfing, the bullish engulfing is just the opposite. So let's take a look at a bullish engulfing. Again, it's going to be the opposite, so we're going to see a long extended downtrend. And the longer, the more meaningful it's going to be. And then yesterday, we get a red candle, which looks like this downtrend is still in full force. But then something happens today different. Today we get this green candle. But not only is it a green candle, look at the formation. The green body completely engulfs yesterday's candle. And the only way this formation can happen is that we had to gap down. That's the only way we could get the bottom of the green to sit below yesterday's candle. So for the red, remember the top of the red is the open, the bottom is the close. For the green, the bottom is the open, the top is the close. So how did the bottom of the green sit lower than yesterday's candle? It had to gap down. So we had this red candle yesterday, and then today prices gap down. This is our opening trade. So right off the opening bell, it looks like prices are going to continue lower. But something happens during the day. Now again, there might not even be significant news, but for some reason the market rallied, pushing the closing price to sit completely above preferably the high of yesterday, but certainly the opening trade for yesterday. So when we get this is our signal candle here in green, and we would expect that the markets would be on the verge of a strong rally. Now again, would I act on just this second candle, even though it's called the signal candle? No, I would wait for 2 or 3 candles on this side, see if it looks like we've got a rally starting, and then take that position. Now, of course, that also depends on what type of trader you are. That's more of a longer term view. If you were trying to day trade this, yeah, you might want to just take a shot and act on this green candle. But remember, that's acting more on noise. So don't be surprised if it doesn't work out. So let's take a look at some examples. We'll go over to the E-Trade platform and see if we can spot some bullish and bearish engulfing patterns. So now we're into the E-Trade platform. I'm going to use Home Depot for this example. So this is back in June of 23, and we went on this nice big run through here. Lots of green candles. This is the significant uptrend I was talking about. Now you can also see some of the bodies were starting to get smaller in here. That's just the height of either the green or the red candle. A couple of long-legged doji in here. But look at this right here. See that red candle? Completely engulfs yesterday's candle. Now it doesn't engulf the high. So this is probably not a perfect textbook example. But the thing to notice is that yesterday's candle was very small bodied. This candle right here gapped up. That's how the top of the red got above yesterday's candle. But then it quickly sold off. And in fact, it closed very close to the low. So what's the story behind it? Don't get too wrapped up into whether it's a perfect textbook bearish engulfing pattern or not. The story is we were in a significant uptrend. We got a small-bodied candle yesterday. Bulls were trying to push it up, but we can even see that yesterday bears were starting to show up. That's how we got this big upper shadow. But then on this date, something significant changed. And that was kind of the start of the sell-off. Okay, let's go back to, looks like about October of 2022. And here we can see that we got this pretty extended downturn. Little hint of a rally through here, but sold off again. Got three big red candles in a row right there. But then look what happened right here. We have an engulfing pattern. And in fact, it opened at the low, or at least close enough, and closed at the high. So again, think of the story. Big sell-off coming through here. We gapped down. That's why the green candle down here opened below yesterday's candle. And then something happened during the day. The market reversed and it closed near the high. Why would it do that? Well, for some reason, buyers have stepped in. Now, once we couple our candlestick patterns with moving averages, we can see that this occurred right on a major moving average. In this case, the 1,000-day moving average. So if that happens, if you get a major candlestick pattern also on a major moving average, it just magnifies it. It becomes a stronger signal. And that is right where we started this nice extended uptrend. So there's a quick look at the bullish and bearish engulfing patterns. Remember, I do have a complete candlesticks course available on the website as well, but I hope that's enough to at least help you to make sense of engulfing patterns. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a Candlesticks and Technical Analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.